What if I told you that you could turn your extra $5 a day into hundreds of thousands, if not $1 million? What you talking about, Jasprit? It's the exact same strategy that Earl Crawley used to earn a net worth of over $500,000 while never earning more than $12 an hour. And it's the same strategy that many teachers have used to retire with millions of dollars, even though they didn't make a huge salary. No, you don't need a finance degree or luck or have money to start with, but you do need the ability to think long term. $5 a day is about the cost of your Starbucks coffee. Now, if you took this extra $5 and you saved it under your mattress every single day, it would take you about 540 years to become a millionaire. Nobody's got that type of time. But watch this. If instead of taking this extra $5 a day and shoving it under your mattress, you took this extra $5 and you invested it. And you're not the best investor. All you did was get the average returns of the market, which historically has been around 10% a year. And you did this over the course of 45 years. Even though you start making more money, you don't invest any additional money. You're just investing the same $5 a day. Well, after these 45 years, you're gonna have more than $1.4 million. You didn't start with a lot of money. You invested the $5 a day. You didn't have a bunch of financial knowledge because you just invested your money into the market. You just let the markets do their thing, and now you're a millionaire. Now, every time I teach this, I get the exact same responses. Number one, Jasprit, where in the world am I supposed to get this 10% return in a year? I don't know how to invest my money and do that. Number two is, Jasprit, I don't want to wait 45 years to become a millionaire. Who wants to wait until I'm old to become wealthy? But let's break this down and let me show you how you can actually do this and maybe not have to wait that long. Now, I don't know you, I'm just a random guy on YouTube, but I think we can agree that you can find an extra $5 a day if you were to try. So we're in agreement here. Now, the first question is, well, Jasprit, how do I actually get this 10% annual return? And this is where you have to understand what it means to invest your money, because the whole idea of investing your money is you want to take your extra money, in this case, $5 a day, and you want to put it into an asset, into a thing that's going to make you money. Period. That's all investing is. It's not about spending hours a day trying to find the best stock. It's not about trying to trade things. It's just about taking this money and putting it somewhere and letting this asset do its thing. I don't want you to spend hours a day. I don't even want you to spend hours a month doing this. I want you to set a system, set it and forget it. That way you don't have to worry about it. And there are simple ways to do this and automate it. That way we just take this $5 a day, put it to work, and let the money do its thing. That way you can grow by 10% a year. Now, there's a lot of ways that you can invest your money. You can invest your money into stocks. You can invest your money into real estate. You can buy a business. But we're talking about $5 a day. And the simplest way for you to invest this $5 a day is to invest your money into the stock market. Now, the stock market is a place where big companies like McDonald's and Amazon and Apple allow you to buy ownership in those companies. So if you buy one share of McDonald's, you become one of the owners of McDonald's. You don't have to go and try to flip burgers. You don't have to go and actually work in the company, but you get your share of profits. And there's two ways you can get paid. You can get paid through what's called a dividend, which is when some companies, like McDonald's, have billions of dollars of profits at the end of the year. They can take some of those profits and just give it away to the shareholders, people like you, with a dividend. It's a cash deposit that you get into your account for doing nothing except owning the stock. The second way that you can get paid is through appreciation. This is when the value of your stock goes up from, say, $100 to $200. Now, the thing about the stock market is that the stock market has grown by 10% a year on average. Yet so many people lose their money in the stock market, which might have you wondering, well, if the stock market grows by 10% a year, why are so many people losing money? Why do so many people feel that the stock market is rigged, that it's a casino? And the reason why is because a lot of people don't have a strategy. What they try to do is, number one, they try to find the next Amazon, the next Apple, the next Nvidia. They're trying to find the next hot stock. And then number two, they don't know when to buy. Number three, they don't know when to sell. Number four, they don't know how to research the stock. And then number five, they don't know how to find an undervalued company. Now, all of this is possible, but it takes a lot of work and time and energy and research. And I'm not saying you shouldn't do it, but there's a lot simpler ways to get started. If that's something that you're interested in, I'm not going to go into that in this video. You can check out some of my other videos. But the whole idea with you just investing your money to get the returns of the market is not you trying to find the best company. It's just you want to invest your money into the market because you want it to be completely passive, completely hands-off. So what if you could just invest your money into a thing that gave you exposure to the stock market? Or even better, what if you could invest your money into a thing that will give you exposure to just the biggest companies in the stock market? And it's 100% possible. And you can make it completely passive and automatic, so you don't even have to work for it. This is where you can take your extra $5 a day and invest it into an ETF. Now, an ETF is called an exchange traded fund. All this is a fancy way of saying this is a group of stocks. Now, there are ETFs for a lot of different things out there, but let's stick with the most basic and simple examples for the purposes of this video. There are ETFs like VTI. This is the ticker symbol of the ETFs. If you wanted to buy this is what you're buying. I'm not telling you what to buy, just giving you an example. But VTI gives you exposure to the total stock market. So now instead of investing into the thousands of companies that are in the United States stock market, you just buy one share of VTI and you're getting exposure to the entire United States stock market. You don't have to worry about markets going up or down. You don't have to worry about trying to find the perfect company. This just gives you exposure to the total stock market. Or let's say you wanted to get a little bit more granular. You wanted to invest in the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. Well, there's an ETF for that. Now, you can invest in something like SPY. Again, just an example, I'm not telling you what to invest in. SPY will give you exposure to the 500 largest companies in the stock market. Now, you're not investing in every company in the stock market, you're investing in the 500 largest companies. And this is where things get interesting, because we know that some companies go bankrupt. We all remember Sears and Bed Bath & Beyond and Blockbuster. Well, what happens here is when you invest in the 500 largest companies in the stock market, if one of the companies in your fund were to go bankrupt, the fund would kick that company out and replace it with a different company. So let's assume right now that the top 500 companies include stocks like McDonald's. It includes stocks like Apple. It includes stocks like Amazon. All of these companies you would get exposure to when you invest in either one of these companies. But if investing in something like SPY, which is giving exposure to the 500 biggest companies, these are 3 of the 500 biggest companies. Now, if McDonald's starts serving really bad hamburgers, and now they start being really bad, and they're on the verge of bankruptcy, well, if you invested into the McDonald's stock, you would lose all of your money. But because you invested your money into this fund would kick McDonald's out and then replace McDonald's with a new company, and you don't have to worry about doing anything. That's why this can be passive, because now you can just find a brokerage out there. There are so many brokerages. You can check out my affiliate brokerages down in the description if you're looking for one. But you can just find a brokerage that allows you to passively invest into these types of funds. And now you create a system where you set it and forget it. Maybe you invest every week, maybe every 2 weeks, every month, it doesn't matter. You pick cadence, you set it and forget it. But this is the key. You want to do this no matter what. The mistake that so many people make is they'll get excited to start doing this, and then markets go down. You're experiencing your first market crash, your first recession. And now when markets go down, you start to freak out because all the news says that we're going into a recession, that things are bad, that markets are going to get way worse, that we're going to see a huge crash. This is just the beginning, and people panic and then they sell. And now you bought high and you sold low, and you're very upset because you were hoping that this was going to make you rich, and you just lost so much money, so much hard-earned money. But this is where, remember, we talked about the long term. And that's why you have to have the long-term mindset that when things go wrong, you follow what I like to call ABB. Always be buying. When those markets go down, you keep buying. In fact, the only change you might make is you buy even more, because recessions and market crashes create more millionaires than any other time. Why? Because they allow you to buy more good investments at a discounted price. Because when markets go down, the stock market's on sale. People are running away. But that allows you to buy even more. When Amazon has a sale, people are lining up to buy more for Cyber Monday or whatever Amazon Day is. People want to buy more when it's on sale. When the stock market goes down, people run away, but that can create an opportunity for you. And that's where you have to remember, ABB, always be buying when you're buying a good asset. And so now when you see those opportunities, that creates a buying time for you to keep buying more, but you have to have the long-term mindset, because sometimes the recession could take weeks, it could take months, it could even take years. but you gotta be willing to stick with it if you wanna see the long-term growth in your wealth. Now, for those of you that are investors or want to become investors, my team at Briefs Media publishes a free daily report called Market Briefs, where we break down what's happening in the economy, housing, stocks, crypto, and global markets into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and when you join Market Briefs, you're also gonna get access to my investing masterclass as a complimentary bonus, where I'll walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. So if you wanna get the investing masterclass and Market Briefs, all you have to do is click the link down in the description below. So now we talked about why investing is important and how you can start investing your money. And now when we talk about getting this 10% return, remember 10% is the average historical stock market return. That's what the S&P 500 has averaged over the last 100 years, despite the market crashes, despite the recessions. Does that guarantee we're gonna see 10% a year in the future? No, but that's what we have seen despite the ups and downs. So that is something that we know over the long term has been proven to build wealth, and we can expect that it will continue to do so. Does that mean it's going to go straight up? No. We will see more recessions. We will see more market crashes, but if you stick with it, this is what wealthy people are doing because they believe in the future of the markets. Now, the next question you will have is, okay, Jasprit, I get it. If I invest my money into these boring things, I can build wealth over the long term. But I don't want to wait 45 years. I don't have that much time. Well, what can I do to make this return faster? And there are 3 factors that will determine how wealthy you will become. I call it time, return, and money. TRM. These are the 3 factors that will determine how wealthy you will become. Now, the one factor you cannot change is how much time you have ahead of you. We can't go back in time and start investing 5 years ago or 20 years ago or 30 years ago. The soonest you can start is today. And what we know is that the longer your money has time to grow, the wealthier you will become. So we cannot change this one. But you can change R and you can change M. And so this is where people say, well, Jasprit, I don't want to wait until I'm old to become wealthy. And so what ends up happening to a lot of those people is they become old and they're broke. So the first thing I would say is, would you rather be old and wealthy or old and broke? Hopefully old and wealthy. But now let's talk about how to make this even better. How can you become wealthy when you're younger? And if you want to become wealthy when you're younger, well, you can't change time, but you can work on the R and the M. Because these 3 factors working together are going to determine how much wealth you're going to have. So if you want to have shorter time, you're going to have better return or more money. So the most simplest is, well, you can invest more money. We're talking about $5 a day here. Remember that. If you want to become more wealthy, well, you can invest more money. You can work to spend less money. You can work to earn more money. There's a lot of ways to do that. And if you have more money to invest, well, you can just put this money into a calculator and see, if you invest more money, how much will you have to invest to have $3 million or $5 million, or to have the $1 million a lot sooner? The other thing is you can focus on the return. How can you get a better return on your money? Now, I do want to give you a little bit of a disclaimer that when you take on more risk, you can see more return, but it also comes with more risk. I'm not an advocate for you to become a trader. I'm not an advocate for you to go and do options or any of that stuff, but there are ways for you to invest in your own research and into your own financial education to try to get some better returns. Because yes, you can look for where opportunities are. This is one of the things that my firm Briefs Pro focuses on, because our analysts are researching what we call a market shift. Market shifts are a shift in spending, a shift in where money is going, because that's going to change which companies are going to make money. For example, one of the types of shifts that have been really popular recently is a government shift. When we see that the United States government is spending more money on defense because they're passing hundreds of billions of dollars of defense spending, well, that means that the defense companies in the United States could be seeing more and bigger contracts from the United States government, which could help those stocks. That's the way that active investors think. Because everything we talked about here is a passive strategy. You set it and forget it. You don't have to worry about it. You just invest your money every week, every 2 weeks, every month, and you don't even have to think about it. That's passive investing. Active investing is now where you're looking for more individual opportunities. You're looking for more of those stocks, more risk for more potential return. We've all seen it. Some stocks grow by a lot more than 10% a year. But that takes more time and effort and energy to keep up with that, which is not for everybody. But if you're looking for ways now to grow your wealth faster, well, this is where you can work to grow some of that return. How can you find those opportunities where you can try to beat the average returns? Now, a lot of people are not going to be able to do that, but it is possible if you're willing to put in the work and the research. And this is going to require you to put in the time. Number one, to learn how do you analyze a stock. How do you read an earnings statement? How do you study a financial statement? And then how do you analyze the stock? A lot of people are just buying random stocks they hear about on TikTok or Reddit or YouTube with random people on the internet, and then they hope that they're going to get rich, and then when they don't, they hate the entire economic system and they think everything is rigged against them. Well, you got to be willing to put in the work. And now, when you're spending the time in researching and paying attention to that, this is where you have the opportunity to see potential bigger returns. That way you can build that wealth even faster. So, if you want to become wealthy, the way that you do it is by investing your money. You can become a millionaire with $5 a day. The average person can do that, but the thing that holds so many people back is not how much money you're making, because remember, in the beginning of this video, we agreed that we can try to find this extra $5 a day. How do you do that? Well, you can just invest your money into the markets. If you're doing it for a long enough period of time, you will become a millionaire. But the reason why so many people get turned off is because, well, it requires you to do this for 45 years. And it's not super exciting because it's slow and steady growth. But if you can get over those emotions, you can become wealthy. And if you want to become wealthier or become wealthier sooner, then you also have to focus on here. How can you invest more money or get better returns and then find the right opportunities for you? Again, if you want some additional resources, you can check out Market Briefs, which is my free financial newsletter, and I have that link for you down in the description. President Trump signed the One Big Beautiful Bill Act into law. This big bill will bring some big changes to our economy, starting with some big tax breaks to big funding for certain things like more deportations. And the reason why you want to pay attention to this bill is because it goes into effect retroactively. It goes into effect January 1, 2025.